Hello and welcome to The Upside. I'm Kyle Cheropita. Today we're diving into what makes founder-led companies unique. A founder is not just steering the ship, they built it from scratch. They typically think longer term, in years or decades even, not just quarters, while being powered by purpose, personality, and persistence. This relentless drive is the special sauce that sets the tone, the vision, and the heartbeat of a company. Tom Williams, portfolio manager of Fidelity Founders Class, joins me today to share more about the founder advantage and the philosophy and strategy behind the fund that is focused on harnessing the entrepreneurial spirit of founder-led companies. Hello, Tom. Thanks for being here today.
Great to be with you, Kyle.
Hey, I really appreciate you joining me. I'm really looking forward to this conversation. And let's just jump right in and talk about the philosophy and strategy behind the Fidelity Founders Class.
Well, the thing that draws me to this strategy is that investing alongside founders is really very intuitive. And it's possibly the most intuitive to people who are founders themselves, to listeners who are founders themselves, who perhaps own a business. And there are a couple of things to say. But firstly, we see superior economics from these companies. They typically have faster growth, they have higher profit margins, they run stronger balance sheets, they have higher patent formation. But it's not a happy coincidence that this is the case. It is a direct result, I would argue, of the fact that they have a lot of skin in the game. So if you imagine that you owned a company, you own 20% of a listed company, you would probably invest more in R&D so that your business would produce more patent applications versus the typical company. So as a result, you might grow faster. You'd have better products, so you might be able to charge better pricing for them and have higher margins as a result. You might own your real estate. You might even build your own software. The reasons being that you don't want to pay rent on an asset that you're going to own in perpetuity. You'd rather own it outright. You don't want to pay subscriptions on the software, so you might build it yourself. So it's a very different mindset. But the thing that is perhaps the most difficult to wrap your head around is that a lot of the advantages are intangible. They're things that are hard to prove out empirically. And I'm talking about culture. Mm-hmm. And I'm thinking about an example of this. So the fund owns a company called Steel Dynamics, which is a steel company. And how is it that a steel company, which is very capital intensive, it's very cyclical, can outperform the Russell 3000, which is our benchmark over the last decade? And the answer, I think, is culture. And that's instigated by the CEO, who's the co-founder, an Englishman actually called Mark Millett. And so they don't have any patents at Steel Dynamics, but they've created a culture where they can leverage this equipment that you and I could buy off the shelf and use it much more effectively than competitors. And they've done that by having this very incentive-rich culture where they split 8% of the profits, the pre-tax profits of the company, with the employees every year based on productivity, return on asset targets, and they really take care of each other. So I think that's a good example of how these sort of non-empirical factors can really work in the advantage of founder-led companies.
So it might be a little bit of an intangible, but would you be able to capture that, say, by visiting a company on site, seeing what that vibe is at the business, maybe even talking to people that are underneath the founder?
I think so. It can be a double-edged sword visiting companies. Sometimes when you visit companies, they say that travel can narrow the mind in investing, because it's one often comes back having invested the time to go and see them more positive than before. But actually, you get a good sense from talking to people who are below the C-suite level of management, just in terms of how invested they are in the success of the business. So unhappy employees typically is a pretty bad sign, right? Where people are not being taken care of and not feeling rewarded for the work that they do.
Now, for Fidelity Founders Class, you focus both on founder-led companies, but also founder-influenced companies. Could you explain the difference between the two?
Primarily, we are looking for companies where the people running them have a lot of skin in the game. Mm-hmm. So they own a significant stake in the business. So we want two things. Firstly, we want that big stake in the company. The reason being that when the business does well, the founders do well, and we do well alongside them. But we also want them to have significant influence. So they need to have a board seat as a minimum. Ideally, they're the CEO or the chairman or the executive chairman, but that's not always essential. So the fund owns a company called Arista Networks, which is a a data center Ethernet switch manufacturer. And the founder is not the CEO. The founder is actually the chief development officer. And that frees him up to spend time focusing on R&D whilst the day-to-day running of the company is handled by a separate person. And they've done a fantastic job. It earns 30% on its capital. It's got a net cash balance sheet. So skin in the game plus significant influence. Those are the key factors. Sometimes that's a founder. Very often that's a founder. It might be a later generation, but it could also be someone who's come in and really substantially repurposed the business, transformed it, owns a big stake in the equity, and is really directing how capital is allocated.
Very interesting. Very interesting. Now, you mentioned a steel company earlier there. I am curious because it seems like a lot of the household names, for founders are in the tech space, but is that a bit of a misconception that all founder-led companies are in the tech space?
It does seem that way at the moment, doesn't it? Because there are so many huge companies at the top of the indices, which are technology companies that are also founder-led. But as you mentioned, and as I mentioned with Steel Dynamics, there are founders in all manner of industries, and we own securities in a broad selection of different industries. And what is intriguing is that very often these companies stand out because they are earning better economics, so they're making higher margins or they're earning higher returns on capital than the median company in those industries as a result of some of the factors that we just talked about.
Right. And financial as well, like your Fidelity, for example, you're sitting in the Boston headquarters right now, usually based in the UK, but the Johnson family themselves.
Indeed, a third generation family business. But of course, the story of Fidelity did not begin with the Johnson family. The Fidelity Fund was an acquisition by our current CEO's grandfather. So that would be an example of what we would call a refounded business, where the origins perhaps start with somebody else, but then over time they own a very significant equity stake and are directing the operations of the company.
That's very interesting. Now, I imagine with your role, and you're supported by a great team of analysts, you're meeting with a lot of companies. And do you have any specific stories where you've seen a company and a founder really grow over time?
Yeah, and I've got to say that's really one of the great privileges of the job, seeing these companies developing over time. But really the people who are running these firms are doing the real work of designing and creating products and services that make life better, that make life possible, make life easier. But we do need to be alive to adverse change as well, where there are possibly threats to growth, and that's something that we're very sensitive to. For example, we were shareholders in Netflix until quite recently, but we sold after the Warner Brothers Discovery acquisition was announced. And sometimes you see with major pieces of capital allocation like that it's telegraphing a degree of maturity in the core business. If the company is prepared to spend, it was 83 billion to buy a company that it's spent years disrupting, it may be a warning sign that things could be slowing down ahead. I reserve the right to change my mind in that situation. They were just led enough to walk away from that acquisition. But potentially significant that the founder, Reed Hastings, stepped down as executive chairman not long after that bit was abandoned.
So here at Fidelity, you have a world of research resources available to you. I'm really curious if you could share a little bit more about that, about the team that supports you behind the fund.
Yeah, well, this is really a team sport. There's too much going on in the world to approach this alone. And I'm really fortunate to be here at Fidelity with a huge team of analysts, both here in Boston, but also in Europe and in Asia. And those guys are really my eyes and ears, just as I'm the eyes and ears for them as well. We spend a lot of time brainstorming ideas and trying to disprove different ideas and make them stronger in so doing. But really the craft of investing, if you can call it that, is a process of osmosis. And when I think back over my time at Fidelity, a few things stand out. Walking the exhibition hall with Will Danott, who runs Fidelity Contra Fund, and talking to the operating managers at the Berkshire Hathaway annual meeting. I had a chance to talk to Peter Lynch about the fund when we were setting it up. I spoke to Mr. Johnson, our current CEO's father, about founder-led companies before he passed away. Really, these are the pinch me moments in my career. It's really a great privilege to have access to that. But we are also able to talk with a lot of founders around the world, which is superb.
It's great. I did want to explore more about the launch of the Founders Class here in Canada, which was in 2018, and I understand you started a similar strategy globally at the time. But maybe first, I'd like to hear just a bit more about your career path. Who is Tom, and what's your story?
Well, yes, Kyle, you were there at the very beginning of the inception, the founding of Founders Class in 2018. But I mean, serendipitously, it was my colleagues Will Danoff and Joel Tillinghast who really came up with the idea of Founders Class, and recognized that there was a lot of alpha amongst companies where the founders have major skin in the game. But at the same time, I come across a body of academic research, more than a dozen academic papers from the 90s and the 2000s, which showed that founder-led and family-owned companies outperform the indices. We did a lot of back-testing work just to try and verify some of that data. That was also in 2018. So we both arrived at the same conclusion at a different time. I ended up expressing that through the Global Founders strategy, and my predecessor on this fund, Dan Kelly, expressed it for the Founders Class. Mm-hmm. So now it's good to have them all under one roof.
Yes. Yeah, so just for everybody's clarity, so the fund initially launched in spring 2018 under Dan Kelly, and then if I have all my facts correct, the two of you sort of co-managed during the transition last year, and then towards the end of the year, you became sole manager on the fund?
That's correct. Yeah. Dan and I have known each other for more than a decade. We're both very energized by founder-led companies. He's a fantastic investor. I've learned a huge amount from him. My approach does favor slightly higher concentration, so the name count in the fund has reduced somewhat. At the same time, we've added some new holdings, and given my background looking at founder companies around the world, we've also taken advantage of the Founders Class ability to own up to 20% of the fund in securities outside the USA.
Interesting.
And we're really excited to see how these companies develop over the next few years.
I did want to share a quick story about Will, because I remember when recording the initial fund launch video with Dan Kelly back in April 2018, part of the story at the time, like you just said, a lot of those key points about the thesis behind the founder advantage, and then Joel and Will being real champions of the strategy and really pushing for it in its initial pilot stage. And we were recording the initial launch video, and it was Easter Monday, so a very quiet day in the office. We were up on I believe the 14th floor is where all the meetings happen with companies that come in-house. And there was only one or two meetings happening that day, but one of the few people who walked past the room with his big binder of papers was Will Danoff, because he was known to not turn down a meeting, and he poked his head in, and he was just gushing at the possibility that this fund was launching, and he knew the power of the story behind it. So it's just a really positive Fidelity story, in my opinion.
Yes, well, Will, some of Will's success, there are many reasons for it, but one of the great ones is that he has this wonderful network of founder-led companies and knows the founders very well, and has been able to understand what the investment landscape looks like through the eyes of people who have a lot of their own capital at stake. And I think that's really a key learning, that if you're going to invest alongside people, you want to invest alongside principals who have skin in the game. You don't want to necessarily invest alongside agents who are allocating other people's money. Yes. And Will discovered that early on. So it's great to have an expression of that idea through the fund itself.
So you're sole manager now on Fidelity Founders Class, available to Canadian investors. And you mentioned a bit of this already, but do you have any more good news stories of current companies that are in the portfolio, maybe some changes since the Dan days?
Yeah, well, I was thinking about this. It might sound like a strange answer to your question. I'm attracted to this idea of post-traumatic growth, which may not sound like a good news story, but we're all very familiar with post-traumatic stress and what that means. But there is this concept of post-traumatic growth where one can go through some sort of trauma and emerge from it stronger. And the same is true of companies. So the fund has a big position in Marriott International, the hotel business, which is really a fascinating company. And they've benefited from post-traumatic growth. Because the problem, of course, with most businesses, non-founder or non-family businesses, is that there's no real institutional memory in the company. So they tend to make the same mistakes over and over again. The CEO gets fired, and then a decade later, another CEO makes the same mistake. And so it's the shareholder who ends up paying the price for that. And so many years ago, I read Bill Marriott's business biography, and Marriott itself has a fascinating history. I mean, they were founded in 1927. They actually didn't open their first hotel for about 30 years after that. And they were the pioneer of those little meals that you get on planes, in-flight catering. That was invented by the Marriott. It used to be a root beer stand right at the beginning. But wow. Things didn't always go to plan. And in the 1980s, they started building huge numbers of hotels, and they became really a real estate developer as much as they were a hotel company. They had some misadventures in mezzanine finance. They got into timeshare, things like that, which didn't go too well. But the thing is, those experiences are they are scars on the back of the family, of the Marriott family. And so now the company is a franchising business. It's a capital light model where the low returning real estate is provided by third parties, but they benefit from being on part of the Marriott ecosystem because they are generally able to charge higher room rates. They get better occupancy as a result of the loyalty program and from using some of Marriott's brands. And so, this has been a great investment, I think, for the Marriott family. It's been a strong performer for the fund as well. And David Marriott, who's the third generation chairman of the company, is the family representative. They're also the biggest shareholder. And interestingly, I'll define those ideas that it's under the third generation that things fall apart. It'd be nice if there was such a rule of thumb, but the reality is that you've got to look at every company on a case by case. He's done a great job.
Right. Well, since you said falling apart there, I wouldn't mind prodding at that a little bit more and talking about founder risk. What happens when a founder either leaves the company or becomes a bit of a detriment and a risk to the company?
Well, ultimately, we are looking for key man risk or key person risk, and sometimes that surprises people. But that's one of the important factors that we're looking to invest alongside. It's kind of the point of the strategy. It's the point of the fund. But exits, you're right, they do happen occasionally. Founders do leave from time to time. Sometimes they may elect to sell the business entirely. But we've been able to benefit from that indirectly. So many years ago, there's a company called Medline, which is a hospital supplies distributor, which we own in the fund. It was founded by the Mills family of Illinois, and I studied the business when they sold a controlling stake to Blackstone in 2021, and extraordinarily, it had grown every year since it was founded in 1966, which is very rare. Very free cash flow generative business, capital light distribution model. But we had the opportunity to become shareholders ourselves because Blackstone were looking for an exit last year. And so the company was taken public. The Mills family are still substantial shareholders. They're still board members. So they're really fitting those two criteria that we're looking for. And it's been a good investment so far. So we're excited to see how that one develops over the next few years.
Very interesting. Now we're nearing the end of our conversation here, but I was curious as well about geographic allocation for the fund. And you mentioned before you're in Boston this week, but based in London. And does being based in London give you any advantages?
I think it does. So the US market, the majority of the fund is invested in US securities, but the US market opens at 2:30 London time. So that gives me time in the mornings and in the early afternoon to research, to read, and to think. And that sort of headspace I would regard as valuable. And it also means that I can talk to founders and our analysts in Asia in the morning, London time. I can talk to European founders during the afternoon, and then to US founders and the people that are running our US companies in the evening. So being on the prime meridian is definitely an advantage from that perspective.
That's great. And then you're in Boston this week. What are your plans? You meeting with colleagues, seeing any companies? What's the plan for the week?
Yeah, it's a great opportunity to catch up with all of my colleagues, both analysts and fund managers. And what I particularly enjoy is that there's a wealth of experience here at Fidelity. It's we have a research archive that goes back several decades, but there's also a lot of hard-won learnings amongst my colleagues. So, where there are ideas that I'm currently appraising, it's good to brainstorm with colleagues and to understand. Perhaps a colleague was an analyst on the stock 20 years ago and has some good institutional memory on the name that can help me to improve my own thinking and to stress test my ideas.
Maybe have a lobster roll or two as well.
Absolutely. Well, it's raining outside at the moment, which is making me feel very at home as an Englishman. But maybe if the weather clears up.
That's great. Maybe one final question before we wrap up today, Tom. I'm just curious, as we look forward to the rest of the year, what are the main themes that you're looking out for? Any opportunities that you're seeing in the market?
Well, there are always opportunities, and I don't mean that to sound glib, but we're always assessing new opportunities for the funds, new investments for the funds. But equally, we've got to try and balance that against reappraising and rethinking what we already know. One of the challenges of investing is that ideas can become stale quite quickly, and indeed valuations can change quite quickly as well. So we want to try and assess where the best prospective returns lie. But at the same time, we are invested alongside a great set of founders who are allocating capital like it's their own money, because it is their own money. Mm-hmm. And we're excited to see how those businesses develop over the next few years.
Oh, thank you so much, Tom. I really appreciated the chat today. Thank you.
Great to be here with you. Thank you.
See you again. So, and thank you all for watching today. Here at Fidelity Canada, we're releasing new content daily. So please look up the Upside or Fidelity Connects podcasts for more. You can get an exclusive First Look at Upside shows as a streamed webcast, where you can learn to be a better investor and hear from some of Canada's best stock pickers and leading financial experts. To not miss a show, head to fidelity.ca and sign up for the next webcast or the Upside newsletter. Thanks for watching today, and I hope you'll join us again. I'm Kyle Cheropita. Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.